Steve Gross, Principal and Co-Portfolio Manager at Penso Capital Markets, as well as Joe Ransom, Lead Portfolio Manager at Ridgeworth Select Large Cap Growth Fund. Great to see both of you. Joe, let's kick things off with you. Today we've seen this turnaround. The S&P 500 just turned positive a few minutes ago. What's driving it, and do you see it continuing into next week's trade?
I believe it should continue until next week. It's very simple. I think there's still a lot of money on the sidelines. I think that money is going to come into the market by year end as we do our traditional quarter end window dressing. Beyond that, I have some reservations about whether it continues to go up. But I think in the short term, the market will continue to go up, just supply demand.
How about you, Steve? Do you anticipate to see this follow through into the close and then into next week's trade? And where do you see the leadership groups?
Well, I would agree with what he was saying about the idea that there's a lot of window dressing going on. There's a lot of, this is the first big up quarter in the markets, and there's going to be a lot of movement into the end of the quarter. Potentially for the shorts, there's a risk of some kind of melt up, top off until the quarter end, and that's something we're concerned about.
Steve, are people really dramatically underinvested? We hear about oceans of cash sitting on the sidelines. I'm starting to question that assumption, though. I'm not sure that's entirely accurate. We've had an awful lot of money already come into the market. How much more is there out there?
Well, bear markets rallies have sort of three cycles. There's the short covering in the first part of the cycle, and we saw that where the heavily shorted stocks rallied much more than the market early on. We then had a lot of value buyers coming in. Now we're at a stage where hard to make a very good valuation case. The question becomes, is this really just momentum follow through? And one of the things I think is important to think about is that we've had this sort of green shoots. And what's really happening here is that we're taking all these green shoots, we're rolling them into a cigar, and we're smoking hope. And if it works out, then that'll be great. And if it doesn't, then we're going to have a problem, and our fingers may get burned.
Smoking hope. I like that. That's clever. Joe, what about what I was just talking about earlier here, and that is this trade unwinding, this go long commodities, long technology, short the bond. That's clearly falling apart here, but trades can be very powerful, momentum behind them. Is it really over with commodities for the time being?
I think it's over for the short term simply because I think this one has been driven by currency, basic supply demand, and we have no concern for the near term about inflation. We just don't think it's on the horizon. We are concerned, however, that this China trade and the currency trade continues. But one of the reasons we think energy prices will come in the near term is that it's not based on fundamental supply and demand. We think that will take hold, and we more than likely will see some consolidation going through the summer into the early fall.
If that takes place, it could alleviate some pressure on the consumer. Right now, consumers, at least as of May, paid $9.5 billion more for gasoline than they did back in December.
Absolutely. And that's one of the reasons I would guess today you see consumer stocks, at least yesterday, they kind of rolled over as people began to realize that at the margin, consumers have less money to spend than they had a couple of months ago. But once again, we think that is overdone, and we expect to see it come back somewhat as we go through the summer.
The bare assumption is that the consumer will lack the buying power to significantly move the U.S. economy off of the bottom. Suppose we get 0.5% GDP for the next 3 quarters. That's a bottom, but there's not any growth there. Is that a possibility? Because the bears believe that is very likely, and October we start moving down again.
Well, that's something, the bears clearly have an argument. If the markets are going to do well, if there's even, anything other than a complete V-shaped recovery, you're going to see some softness happen later in the year. We believe that there's a lot still going on in deleveraging, and that is not nearly over. If you think about it, a bank has not sold a single toxic asset. What have they done? They've raised 70-some-odd billion of new money, and then they've just turned around and given back all the TARP money. So really what we have here is no more real money to cover losses than we had before, but just a belief system that somehow tomorrow will be better than today.
And if that belief system, is there any possibility that that could make tomorrow, that the psychology of the market, the confidence, could end up making these toxic assets somehow less toxic in the future so that they can actually take care of them and bring them back onto their balance sheet?
Well, there clearly can be some of that effect, the self-reinforcing effect. The one issue with that is that even if the banks were to begin to lend again, they're doing the lending at much stricter standards. So the reality becomes that at stricter standards, there's still less total lending. And so we still see a situation where generally credit is contracting and will continue contracting even if people get more positive, and that will affect prices of these securities.
Just a minute or so left, Joe. where's the rotation here? We've seen utilities pop up in the last 2 days, and I'm getting emails. What the heck are utilities doing here? They're up 3%, 4%. What's going on? But there's a little bit of picking on rotation. Is that realistic at this point? Is it realistic to try to rotate out into defensive names?
No, I don't think it's realistic to try to do, but nevertheless, it's done all the time. And so we think the market leaders looking out next 18 months will more than likely be what the market leaders are today. But in the meanwhile, as the market consolidates, for example, today healthcare, I believe, is up. As it's been down, it's been one of the laggards in the market recovery. And so people are going into healthcare. But looking forward long term, we still see energy, material, and technology as being amongst the leaders as we go forward. We do think it's going to be a muted recovery just because banks will not be lending and the consumer cannot lead us, at least not the U.S. consumer, can lead us out of this recovery.
All right, Steve Gross.
Go ahead.
Steve Gross, Joe Ransom, thanks very much.
Thank you very much.
Guys, have a great weekend.
We have 45 minutes to go before the closing bell.